Hello, my name is Mark Orr, and I've been a certified financial planner and registered investment advisor for over 10 years and have helped my clients make smarter choices about their money based on their financial goals and what's important to them. So let's get started with today's topic. An annuity is a type of insurance product designed to accumulate and grow wealth on a tax-deferred basis. There are a number of types of annuities, such as fixed, variable, and equity index products, all of which are designed to grow your money and also give you the option to annuitize your principal in your account, which will give you an income that you cannot outlive like a traditional pension. There are also immediate annuities, which convert a lump sum of money to an instant income stream for a set number of years or over your full remaining lifetime. Equity indexed annuities are the newest and fastest growing type of annuity product and have recently been a favorite of people who are approaching or already in retirement. So let's talk about them. Equity indexed annuities have all the same qualities and advantages of traditional fixed annuities, where your principal is guaranteed, you can enjoy tax-deferred growth, and if you'd like, you have the option to annuitize your principal into a lifetime income stream that you can't outlive. Anyway, the difference and major appeal of an equity indexed annuity is how interest is calculated and credited to your contract. Now, there are various forms and slight differences between how various indexed annuities work, and insurance companies offer a number of different choices, but most work in a following or a similar way. The interest credited to your policy is tied to an equity index, usually the S&P 500, but sometimes another well-known market index is used. For our purposes here, I'll just talk about the S&P 500 index, as this is one of the most commonly used because it's an index of the 500 largest US-based publicly traded companies. Now let's be clear, even though the interest credited to your policy is tied to how well the S&P 500 index performs, your money is never actually invested in the stock market. What happens is your money is invested by the insurance company in their general account, which is primarily bonds. These bonds and other investments pay an interest rate, and the insurance company uses part of that interest to buy one-year call options on the S&P 500 index. Now, if you buy a call option on the S&P 500, the absolute worst thing that can happen is that the option expires worthless should the index be lower a year from now. But even when the S&P 500 went down by some 37% in 2008, the call options just expired worthless, and the principal in your annuity did not go down one little bit, since your cash was not actually invested in the index. And when the S&P index goes up in any year, the option becomes more valuable and is sold for a profit, and that percentage of gain is credited to your account. Now, all equity index annuities have a floor, which is usually 0%, and that's the least amount your policy will be credited with in any one year, depending upon the policy you choose. In years like 2008, where there's a big drop in the S&P 500, my annuity clients proudly told me that zero was their hero. In other words, a zero return is many times better than a 37% loss. But regardless, the main thing to understand is that your account value can never decrease based on what happens in the stock market. The value of your account cannot go backwards when the stock market goes down. There is usually a ceiling, called a cap, on what the maximum interest rate your policy will be credited with, depending upon how high the S&P 500 rises over the year. So when the S&P 500 index goes up by 22%, the interest rate credited to your account will be limited by the cap in your policy, perhaps 5 to 8%. But most retired people I know can sleep well at night knowing their account can never go backwards when the market goes down, and yet they can enjoy up to mid-single-digit gains in years when the market does well. And unlike in the S&P 500 index, your gains are always locked in and can never be lost by future market plunges, as the market always will go down in some years. Some annuities don't have a ceiling or a cap on the amount of interest that can be credited to your account, as they give you a percentage, say 65% of what the S&P 500 does in your contract year without a cap. So if the market does 6% in one year, you might get 4%. And if the index does 30% in one year, you might get 20% credited to your account. At the end of the day, including the zero growth years, an equity indexed annuity is designed to credit mid-single digit returns over time with no risk to principal loss whatsoever. The other important point to understand about these types of annuities is the reset mechanism. Let's say that you had $100,000 invested in an equity indexed annuity, and at the start of the year, the S&P 500 index was at 940. Over the next 12 months, the index goes down to 650, a terrible year with the index declining about 30%, which is less than a decline than in 2008. If your annuity credited the floor of zero, your annuity account would still be worth $100,000. However, if you had your money in an S&P 500 mutual fund, your account would only be worth about $70,000. But here's how the reset works, and this is extremely important to understand. For the next year, the base of which your equity index gain would be calculated is where it ended the year before. In this example, it would be 650. So if the market gained 20% from 650 going to 780, your contract would now have an account value of $106,000 if your annuity had a 6% cap. Meanwhile, if you had your money invested in a mutual fund, your $70,000 would now only be worth $84,000 with the full 20% gain that year. That's a positive difference of $22,000 in just 2 years in favor of the annuity. That's the power of the reset mechanism that works in your favor, even with caps and ceilings. So to sum up, because of the way an equity indexed annuity has floors on losses, and even with its limits and caps on gains, the resetting mechanism can make it a pretty attractive but conservative place to build your cash. However, in the next video, I'll explain to you why in 75 to 85% of the time, depending upon your particular circumstances and goals, putting the same money into an equity indexed life insurance contract is probably a much better proposition for you in many ways. Yes, you heard that right. In many cases, owning an equity indexed life insurance contract will be much more desirable than having the same amount of money invested in an equity indexed annuity. In any case, knowing that your principal can never lose money when the market goes down makes either equity index product worthy of a place in the safe or conservative portion of your investment portfolio. If you want to learn more, let's talk about all of your options. Contact me today so we can get started discussing your financial goals and concerns and which type of equity index product might be best for you.